he says tariffs give us great power to negotiate. Specifically says every country's calling us. That's the beauty of what we do. We put ourselves in the driver's seat. If we'd asked for the countries to do us a favor, they would have said no. Now they're doing anything for us. The tariffs give us great power to negotiate. Now, keep in mind, 6 countries, maybe 7, are really at the heart of this tariff negotiation because they represent the bulk of the dollars. If you look at the dollar amount of goods imported on the left side, okay, and there's a lot of countries listed here, the overall tariff rate, according to Goldman Sachs, is 12.6%, which is actually better than Goldman feared. At 15% was their base case. And the reason it's not in the 20s is because there's a lot of products exempted. But I do want to focus on those 6 or 7 that I just mentioned.
Tom Lee boldly asserts that stocks might rise by a further 20% this year, leveraging the recent market confidence. As Wall Street struggles with inflation pressures and recession fears, Lee cites robust consumer spending, robust earnings, and a possible Fed rate decrease as the main forces behind this positive prognosis. But he's not just throwing out wild predictions. Tom Lee supports this with statistics showing how previous market cycles exhibit comparable tendencies just prior to significant rallies. He also cautions investors against getting sucked into the clamor and advises them to put their attention on long-term principles rather than immediate anxieties. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
But I want to give you a rundown on our take. First of all, the tariff rates that were shown are absurd. You've heard from many people talk about this. They are very hard to believe because the tariffs levied on China, for instance, is 34% on top of a penalty of 20%. Europe now has a 20% import for all products. Japan, 24%. Korea, 25%. I mean, Japan and Korea are allies. Additionally, I'm sure you've heard, but these exhibited tariffs charged to USA rates are not actually tariff calculations, but it looks like it's a measure of the measure of the total deficit to the amount exported. Now, there are plenty of signs that Trump wants a deal. Now, I know I just showed you his lieutenant saying he doesn't want a deal. But keep in mind a couple of things. The implementation date for the higher rate is April 9th. That is a delay, and I think that's intentional. And in fact, Trump himself, and I'll share later, despite what Lutnick says, actually has commented that he believes that he can strike a deal. He gave an interview on Air Force One Thursday evening after the market closed, and he says tariffs give us great power to negotiate. Specifically says every country's calling us. That's the beauty of what we do. We put ourselves in the driver's seat. If we'd asked for the countries to do us a favor, they would have said no. Now they're doing anything for us. The tariffs give us great power to negotiate. Now, keep in mind, 6 countries, maybe 7, are really at the heart of this tariff negotiation because they represent the bulk of the dollars. If you look at the dollar amount of goods imported on the left side, okay, and there's a lot of countries listed here, the overall tariff rate, according to Goldman Sachs, is 12.6%, which is actually better than Goldman feared. At 15% was their base case. And the reason it's not in the 20s is because there's a lot of products exempted. But I do want to focus on those 6 or 7 that I just mentioned. Collectively, that's about $582 billion that are subject to tariffs, or that are, it's $2.2 trillion. And the overall tariffs raised from these are roughly $582 billion, or 70% of the tariffs. So at the end of the day, these are really the countries to focus on. Interestingly, on Thursday's trading day, these 7 countries outperformed the US. I think it's potentially a sign that they expect some sort of negotiation. And in fact, if you look at it since February, these countries, 7 of 7, outperformed the US, with particular outperformance today, especially for Mexico. At the sector level in the US, the left side shows you the 20 hardest hit industries. And I've just highlighted that many of these that were hit have overseas operations, or they're importers of products. So it's not a surprise they're taking a hit. And the ones on the right are basically defensive groups and tire and rubber, which not really too familiar with that industry. In terms of granny holdings, there are 4 stocks that I think do have specific exposure to tariffs because either they import products because of where they manufacture, such as Garmin or Eaton Corp, and of course Amazon. But Apple, of course, has overseas manufacturing. So these 4 out of the 33 names are particularly exposed. But again, as I said, it's really a macro issue because every stock became what I'd call no bid today. And so what do we expect these 6 countries to do? Well, they've got 3 options. They can retaliate, they can do nothing, or they can negotiate. Now, retaliation, I think, is not going to be helpful because there are countermeasures in place. So most likely these countries are going to negotiate. And I think I want to take this in bottom order, but Korea and Japan are allies of the US. I think it's going to be easy to come to some terms there. Canada and Mexico have the USMCA, so they're already negotiating with the US. Europe is a question mark because, of course, they're a very large trading partner. And I think China is likely to have some negotiation because there's give and take here. In fact, President Trump, in that same interview, talked about how TikTok is an example. They have a situation where China will probably approve a deal, but they want something exchange on the tariffs. So the tariffs give us great power to negotiate. So you can see there are reasons to expect some negotiations, and I think probabilities favor a negotiation. And if not, then of course there's a greater risk, which is a recession. And JP Morgan puts the odds at 60% of a recession if the tariffs are sustained. But here's the thing. A recession is very expensive. This is all the recessions since 1929. And in general, the fiscal response, which is what the government has to do, matches the decline of the GDP, which means the median fiscal spend is around 2.2% of GDP. So if the US has a recession, Congress has to spend $660 billion to try to, and that's a minimum to try to get the US out of a recession. Well, that would just negate all the benefits of the tariff.
Tariff Liberation Day, often known as the 2nd of April, was intended to be a show of might. Rather, it caused the S&P 500 to decline by 5%. However, why is that? Many investors hoped that some of the more stringent tariff rates would be loosened by the administration. However, market nervousness surged when Peter Navarro and Commerce Secretary Lutnick made a double-down appearance in the media, emphasizing that there would be no softening. As Tom Lee notes, the market was unprepared for this move. Such a tough attitude was not anticipated by investors, and the discrepancy between expectations and reality caused a selling frenzy. This was more about surprise and risk aversion than it was about lousy fundamentals. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
In terms of individual stock performance in the past week, the top 5 performers were Tesla, Abbott Labs, Costco, Progressive, and Garmin. And the bottom 5 performers are NVIDIA, PayPal, Eaton Corp, Oracle, and GE Vernova. And in terms of styles and themes, the best performing Granny Shots portfolio is the easing financial conditions, probably because investors are expecting the Fed to actually ease. The second is millennials, led by Tesla. And the third is stocks geared towards a PMI recovery. To give you some background, in case you're wondering what a granny shot is, it refers to an unconventional way to do a free throw, which is underhanded, popularized by Rick Barry, NBA Hall of Famer, who made 90% of his shots. In the stock market, our idea of a granny shot is to find companies that are tied to the most important themes driving the market, such as millennials, global labor suppliers, AI, energy and cybersecurity, easing financial conditions, or some tactical things like style tilt, seasonality, or the PMI's recovery. But that's not enough. In order to be a granny shots, not only do you have to be one of the strongest stocks in these themes, you need to appear in multiple themes. So the more stocks you appear in, more themes you appear in, of course, the more likely you are geared towards the most important drivers of the next few years. And that's how we get granny shots. I want to cover some particulars first. The price as of March 30th was $18.14, NAV of $18.15, and total assets of $866 million. It was a tough week for granny shots. Granny shots ETF is down 2.73% compared to a 1.5% decline for the market, or underperformance of 121 basis points. The reason for this is really macro. the markets have become risk off, and it's because of Tariff Liberation Day, which was April 2nd, has triggered a lot of concerns for investors because it was worse than expected. It was a 10% base rate for imports with an additional tariff rate for other countries that have large trade deficits with the US. President Trump referred to this as the operation is over and the patient has lived, but the stock market reaction has been very negative. The S&P on Thursday opened with a 3% gap down, and throughout the day, stocks were reeling. One of the reasons stocks were reeling is that investors were hopeful that these tariff levels would actually be dialed back, but Commerce Secretary Lutnick made multiple media appearances and insisted that President Trump is not going to back off, and that added to selling pressure. Even Peter Navarro did an interview on CBC reiterating that these are not negotiable, and it sent stocks reeling.
In conclusion, Tom Lee provides a lucid analysis of the market volatility of the previous week, dissecting both the performance of individual stocks and the larger macro environment that influenced it. While big tech companies like Nvidia and PayPal witnessed drops, among of the best individual performers were Tesla, Abbott Labs, and Costco. However, the true narrative here is not about which stocks rose or fell, but rather about the reasons behind the market's actions. Lee identifies the pivotal moment as the 2nd of April, also known as Tariff Liberation Day. Investors hoped that tariff levels would be reduced and that trade policy would be moderated. Rather, the government doubled down and imposed higher than anticipated rates. The S&P 500 fell 5% in a single day as a result of the panic that unexpected move caused. Even Tom Lee acknowledges that he wasn't prepared for such a harsh response. It was all about risk aversion and uncertainty rather than business fundamentals or profits. The shock caused widespread market selling because investors were unprepared for that degree of policy assertiveness. Lee also talked about the Granny Shots ETF, which tries to aggregate high-conviction equities connected to important long-term themes like millennial trends, AI, cybersecurity, and easing financial conditions. However, even this ETF had a difficult week, falling 2% and underperforming the market as a whole. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.